This is Radio Free Wall Street with Lee Adler. Find me on the web at radiofreewallstreet.fm or at the Wall Street Examiner at wallstreetexaminer.com. Hi everybody, this is Radio Free Wall Street for Tuesday, May 13th, 2014. And we finally have something to talk about today. The market made new highs yesterday. It is running about even today. It broke out through 1900 a little earlier, has come back and is trading in this very, very narrow range. We'll take a look at the technicals in a little while, try to determine whether this is going to stick or not. There's also been some interesting economic data over the past 10 days or so that I haven't gone over with you, and I'm going to take the opportunity to do that. I think it's interesting, and it kind of supports what we were seeing with the real-time tax withholding data that had shown in the past 5 or 6 weeks some slowing. It had indicated some slowing in the economy that had not shown up in the non-farm payrolls data. I remain suspicious of that data. I think it's probably going to be revised down. But we've now had the job opening and labor turnover survey. We've had the ISM data, both manufacturing and services. And today we had the retail sales data. And all, except for the ISM, were disappointing in terms of the consensus expectations that were a little higher. But they were actually consistent with the weaker data we're seeing from the withholding taxes. I think that there are some signs that the economy is slowing down. Is that going to be a problem for the market? Maybe, maybe not. It depends on a couple of things, and again, we'll get into that as we look at the charts here. First, I'll briefly go over the withholding tax data for those of you who do not subscribe to the Treasury report. This goes back 1 year, and this is adjusted for inflation. The thin line is the 11-day moving average. That represents the typical pay period for most workers. It's either usually 2 weeks or twice a month. And then I run a 4-week moving average of that, which is the red line. You can see that back in the period from February through the end of March. The 4-week moving average was consistently running in the 4 to 5% range in here. Just if you extend that back so you can see on the scale. Right in around 5%. Very strong growth in the, this is a year-to-year percentage change. So it was persistently running at close to 5% throughout that period until the end of March. And then we began to see some drop-off. And we've seen just as persistent a slowing since the end of March, so that the real growth rate is now down to around 2 3/4% year to year. And if you just look at the very short term, the 11-day average, it's down below 2%. So, and it has been persistently slowing, as you can see here. So something's going on in the economy, and this is real time. This is right through the end of last week through Friday. So something's going on that suggests the economy is slowing. And that's why I had thought that the jobs data would be a little weaker than they were. So we'll just have to see if that's not revised down when the May data comes out. So there's a couple other data points, economic data, that reflect a little bit of this slowing. And I think that ultimately a couple of things could happen as a result of the drop-off in tax collections and slower economic data. The most important being that as tax collections slow, the smaller deficits that we've been seeing that have enabled lower Treasury supply each month, less net new Treasury supply, that's going to reverse, and we're going to start seeing, and we already have seen, an increase in the monthly amount of net new Treasury supply. Last week, the 4-week bill was $10 billion more than the TBAC had anticipated just at the end of April when they came out with their estimates for the rest of the second quarter. Already the Treasury is beginning to run a little bit short,
as a result of this fall off in withholding taxes. So if every month they have to start borrowing 10 or 15 or $20 billion more, that adds to the supply pressure on the market.
Now, the Fed has been carefully calibrating the amount of QE that it has pumped into the market to pretty much match the amount of net new Treasury supply each month. Now, they've lagged the market by about 90 days, say. They started tapering about 3 or 4 months after Treasury supply began to come down from what had been forecast. So with QE now scheduled at $60 billion a month and pumping through the primary dealers, that's roughly equivalent to what the deficit has been running. Now, if the deficit should begin to increase, we'll have to wonder if the Fed might be motivated to, quote, pause the tapering of quantitative easing. And so, again, if the economy begins to slow, I think that's going to be a natural response on the part of the Fed. And, again, the market will probably see that as bullish. What would not be bullish is if the Treasury supply begins to uptick and the Fed does not respond by reducing the rate of taper or by pausing. If they allow the taper to continue as Treasury supply is increasing, that's going to be bearish, obviously, because there's less cash going to be available to absorb that new supply. And that's akin to the mistake that they made in 2007 when they stopped printing altogether. They paused in their slow growth policy, and then at the end of 2007 they began the TAF program, the emergency rescue of the banks, but they elected to sterilize that by selling off the system open market account, and that's what contributed to the collapse of the market. So we don't know what their next blunder is going to be, but each strategic error that they make necessitates the next counterbalancing strategic error some years down the line, getting close to the time when the next mistake is due. The economic data next that we're going to look at is the JOLTS, the Job Opening and Labor Turnover Survey, and today's data on retail sales. So let's take a quick look at that before we wrap up.
Last week we were treated to Janet Yellen's favorite indicator. That's the Job Openings and Labor Turnover. Try to say that real fast. Job Openings and Labor Turnover Survey from the BLS, otherwise known as the JOLTS. And it came in at slightly over 4 million jobs. Market economists tend not to pay much attention to this indicator, but I think it has a lot of interesting and useful information. As you can see, the month-to-month changes are very jagged, but this olive line here connects this month of March from this year to last year, the year before, and so on. And you can see while there was a solid rebound in 2010 through 2012, since then the number of new job openings has flattened out considerably. And this is during the period that the Fed has been pumping madly via QE3 and QE4. It hasn't done anything to stimulate job creation. You can see the growth rate down here. This is the annual rate of change. It's now approaching zero. It's down around 2 or 3%. It had been over 10% as recently as the latter part of last year, but the growth rate has been trending down again since 2010, and it is now barely better than zero. Very, very slow growth. I looked at the slow rise in job creation. I wonder how that compared with population growth. After crunching the numbers, this is what I came up with, this chart. Early in 2001, the number of new job openings was approximately 27,000 per million. And then it trended down through the 2006 housing bubble, the 2007, the beginning of the collapse, until today we're down around 16,000 per million of population. We've gone from 21,000 to around 16,000 per million. So another thing I noticed here is that after 4 years of recovery, we've gone from 10,000 to 16,000 jobs per month, And this is while the Fed was pumping like mad. And then compare that to the period from 2003 to 2007. That 4-year period, very similar, and it ran up to the trend line, and then we had an economic collapse. So maybe this is the same thing here. We've gone into a very, very slow period of growth. If you do a little technical analysis, we've come up to the trend line. We've made a double top. This could be a sign of big trouble. Now, of course, maybe the economy will pick up some steam and the job creation will break out. But if you look at the tax data in the last 6 weeks, it's sure not going that way in the short run. This situation is very similar to what we saw with the initial claims data indicating that jobs are stretched to the limit, and this is as good as it gets. So it'll be real interesting to see over the next couple of months if we start to see any accumulating signs of weakness in the employment data. This chart of nominal, not seasonally adjusted retail sales shows that the supposed miss in retail sales wasn't really a miss. Nominal retail sales are right on trend, nothing changing, and all this reflects is the impact of the spending of the top 1% or 10% and the shopping tourists that come to the U.S. from around the world. It doesn't represent the well-being of the bulk of the American people, but in terms of the stock market, it certainly represents to some extent the impact of the Fed's QE and the benefit to the 1% and foreigners able to come to the U.S. to shop, but that's about it. I'm going to take a look at the per capita retail spending adjusted for population and inflation and gasoline sales a little later in the week.
Today, not much of anything happened, although intraday they did go up, make a new high, break 1900. The pause looks, at this point, not anything ominous. It's probably consolidation. The cycle projections still are aimed at the lower to mid 1900 areas, say 1925 to 1965. However, there's still that critical resistance zone, 1905 to 1910, that it would need to get through to reach those higher targets. So for now, it looks like it's going to get there, barring a rapid decompression on Wednesday. I think we will get to those higher projections, and then maybe in the second half do a little more consolidation or possibly a pullback. But insofar as the idea of a top here, or certainly not a crash, but even a top, I'm just not seeing the evidence for it. And I continue to be skeptical that anything bearish can unfold as long as this cash is being pumped into the market. It is not correct to say that the Fed is tightening. It hasn't tightened at all. It has simply calibrated its reductions in QE to the amount of Treasury supply, and therefore there's just as much excess cash floating around in those dealer accounts as there has been ever since the inception of QE 3 and 4. So until that changes materially, I don't see any reason to expect anything to change material in the market. So that'll do it for today. We'll get together again on Friday. Until then, have a great couple days, trade sane, and I'll see you on Friday. This has been Radio Free Wall Street with Lee Adler. Find this program on the web at radiofreewallstreet.fm or wallstreetexaminer.com.